Hello guys, my name is Mubashi and today we are going to analyze NMDC National Mineral Development Corporation Limited, and we are going to analyze its fundamentals and technicals too. So let's start with its technicals. NMDC, sorry, NMDC. So let's watch this weekly chart. So as you can see, NMDC quite went into the consolidation. If we compare this level, and now it has taken this consolidation, we can also say that it is a accumulation phase, and it is manipulation phase, right? And there will be the distribution, a power of 3. I am describing about the power of 3, right? So let's watch the weekly chart. Okay, here. So NMDC has gained around from 18 July 22 to today's date. Has gained around 190% of top. So it is good. It has given a good return within these intervals. But if you watch the monthly chart, you can see that the initially the from it is all-time high when the stock was issued with its IPO on 3 March 2008. It, it was having a value of 90, and it has made its all-time high of 141. From this level, stock is down by the around 45%. So basically, we can say that it is on discount. Currently, it is going on in discount, and also it has made a quite long from to June 2014 to and 1st Feb 2023, right? It has taken lots of time to break this level. I mean, it was the stock went into the consolidation phase for too many years. It is too much. It's someone holding the stock on in 2014, and now in 2023, now he can see 25, now he is seeing the profit. I mean, that's too much for someone to hold this much long, right? So overall the stock is in uptrend now. Finally it has taken its consolidation phase, or we can say now it is in distribution. So now let's analyze its fundamentals, right? So NMDC, National Mineral Development Corporation Limited. NMDC is primarily engaged in exploration and production of iron ore, along with the diamond production and sale of sponge iron, and generation and sale of wind power. Okay, it has a quite diversified portfolio. Okay, NMDC is founded in 1958. NMDC is fully government owned. So we can say it is a quite they are going to get mostly order from the government, and also it is a stable business. We can say that under the Ministry of Steel, specialize in the exploration of minerals including copper, rock, phosphate, limestone, magnesite, diamond, and tungsten. Okay, and produce a variety of products including a high-grade iron ore with a 64% P content, diamond, iron ore, and pellets extra. Okay, so operational metrics, no. Okay, we want uh, revenue split. There is no revenue split here. Okay, so we have to analyze the PNL, but we are just going to watch the stock at the upper level by just looking at the ratios, fundamental ratios, quarterly results, profit and loss statement, and balance sheet and cash flow. These are the your analysis part, right? So as we can see, it has a market cap of 65,000 crores. So it is a big cap. Stock P is 10, and the industry P is 2, that shows that quite stock is undervalued as compared to this industry peers. Okay, return on capital employed and return on equity is quite good. Return on capital employed is greater than the return on equity. That shows the company has a debt, as we can see that 0.14. So debt to equity is 0.14, right? Promoters holding, as we can see that the promoter holding is high, 16.8, and there is no change in promoter holding. So basically that shows that promoters having a strong confidence towards their company, in the company NMDC. Interest coverage ratio is quite high because they have low debt, and EPS growth for the 5 years is quite acceptable, and the EPS for the 10 years is quite very low. As I already told you that it is a steady business because it is also governmentally owned by the it is owned by the government, and it has a business that is exploration of diamond, and generating and sale of the wind power and sale of the sponge iron, and that's why maybe they are having a lowest APS score, but still it is not good. This is too much low, so overall it is not good. Quick ratio is 2.14, and if we quick ratio is 2.14 and current ratio is 2.42, so that's good. But still I have to say that they are having more asset in their inventory, right? And the book value is 33 and the current price is 75. It is around 2x. Price to book value is 2.22. Okay, so sales growth for the 5 years 15.4, that's good. I think, but the APS is growing very slow. That shows that they are not able to efficiently manage their expenses, so to increase their operating profit margin, right? Dividend payout, average dividend payout is for the 3 years is 39%. That's great. If the dividend yield is 4.4%, that's good because the share is not able to generate more returns in terms of the price appreciation. So this portion dividend yield, this dividend payout helped to gain more, if you like 4.4%, if we compare with the stock price, right? So this is a good thing for the company, for the it is investor, right? Because they are able to generate 4.4% return from only from the dividend. EBIT with 6.13, that's good. PAG ratio is minus 0.88, that means company is not in profit. That's very bad thing. Industry price to book value is 2.55, where the company's price to book value is 2.22. That shows that company is quite undervalued, but as we can see that PAG ratio is in minus. That's not a good thing. So let's analyze it is EPS, PE along with it is EPS trend, right? So in Jan 14, the company was having a 10 the P and EPS was 3.68, and in January 18 the company was having a 14 P and the EPS was only 2.64, and in Jan 22 the company was having a 3.2 P and the EPS was 11.85. Okay, in the Jan 24 the company was having a 12 P and the EPS was 5.69. That's why the company's profit is quite very fluctuating. Now the company is having a P of 10 and the EPS of 7.44. So I think the company is quite overvalued as per the P and EPS trend, because as we see that the EPS was always low in terms of and the PE was going along with that, but now the PE is high and the EPS is quite not acceptable at this level, right? So I think there might be going to be a correction. So yeah, so let's quickly compare with its peers. So it comes a top level if you in terms of the market cap, right? So quarterly sales variance quite high from industry peers. PAG ratio is quite we can say quite acceptable, if we compare with the not acceptable, sorry for that. PEG ratio is not good, and the IPS for the 12 months is quite low. Sales margin for the 5 years is quite low. Profit margin for the 5 years is quite low, and the interest coverage is acceptable. Current market price to the book value is good, and the EV to EBITDA is also good. Current market price to sales is also good. ROE good, and ROCE also good. If we compare with the it is peers, there is no pledge, and debt to equity is also good. PE also good. So overall the company is doing good, but the main criteria of EPS is not good. And sales and quarterly sales and profit margin is not good, right? So let's quickly analyze it is quarterly results. So year on year sales growth, as we can see, it was going in the minus. Now it was first of all, it was in June 22, it was having of they were having a 4,700 crore of sales. Now they are having a 6,700 crores of sales, right? So this is a, we can say it is a increase of the around 25 to 30% increase within 3 years of time span. That's not good overall, but we can observe here that the sales were increasing rapidly, but suddenly it is dropped from June 23 to September 23 now, and then it is again up, then again down. So we can observe that it is quite too much fluctuating. See that there was a time then where they were having a 7,000 crore of sales, right? So it is quite too much fluctuating. Material cost, look at the material cost. We can see that they are efficiently able to minimize the material cost. Employee cost, they are also the employee cost, we can say, remain stagnant. It is also fluctuating, but we can say it is quite remain stagnant. Operating profit margin have been reduced, has been reducing over the years, as we can observe that. It should be have increased because they are not able to efficiently generate sales, so they have to increase their operating profit margin, right? But still that 29% and 39% is a good thing, but it is quite too much fluctuating. They have to manage it, right? Interest obligation is very low because they don't have to do, don't have that much interest obligation. Other income is we can see they are generating good amount of other income. That's good. Maybe they are investing, or they are maybe having some kind of FTs. Net profit is from 1400 to 1900. We can say it is a quite good increase, around 40% increase. Now let's analyze it is profit and loss statement, income statement. As we can see, from 12,000 to 23, but we can say around 100% return, not 95 to 90% return. So overall the company is doing good in the profit and loss statement, but still we can observe that the sales is quite too much fluctuating here, from 12,000 to 6,000, then again 15,000. Once they were having a 25,000, then again drop, then again they are it is quite a fluctuating business. Look like initially I was thinking it is not a steady business, but now I think that it is I was wrong, so sorry for that. Material cost, right? Raw material cost, we can see that the company is also fluctuating. Everything is here fluctuating, right? Manufacturing cost, we can see that it is quite increasing. Maybe there was something happening because of which the material cost is increased significantly. Employee cost remain, if we see that employee cost is also too much fluctuating. Operating profit margin, we can see that it is dropping over the years from 64%. On an average from here to here it was having around 50% operating profit margin. Now they are having a 34% margin. That's good margin, 34%, but still it is decreasing. They were initially having 64% margin, but they are not able to sustain that operating profit margin, and that's why it is now it's 34%. Interest obligation is remains low. Other income is the major part of the profit, I think. Now net profit is remains same. We can see that in 2014 they were having a 6,300 and now they have 6,500. That's not increase in the profit and net profit, we can see. Now let's analyze the balance sheet. Equity capital, as we can see, they are maybe they have buyback some of their shares. We can observe the equity capital reserves remain stagnant. They have too much reserves, I can see that. And borrowings, long term borrowings is there is no long term borrowing, that's good thing. Short term, they have short term borrowing, that's good. Fixed assets, as we can observe, they are continuously buying fixed assets. They maybe have sold some fixed asset here. There is also current capital work in progress is going on. That's a very good thing for the company because it is a capital intensive company, so they have to do lots of investment for that. And as I already told you, the major part of their revenue is from their investment, right? As we can see that they are doing good amount of investment here because the company has a very unstable business, as I can see now. So cash from operating activities, that shows that the cash generated from the day-to-day activities, it is around 2000, 7000, 18, 2000, 2 to 4000, 7, 11, around within 3 years they are able to generate 11,000, right? 11,000 crores. Now let's analyze it. It is profit and loss. 7, 7, 14 and 9, around 23 if you add on the depreciation, around 23. Okay, so around 23, and now they are able to generate from that around 9,000 crores. So that shows that they are hardly able to generate collect, we have to say that collect 40% of the cash from the sales. Okay, so that's a very bad sign for the company. It is not a good thing that they are not able to collect the cash efficiently. If they are doing sales but still not able to collect the cash, it is not a good thing. Cash from the investing activity, as we already saw that they are actually investing the cash in the capital for fixed assets. Let me show you that fixed assets purchase. As you can see, they are actually investing for that, right? Cash from investing activity shows that where the company is investing, acquisition, mergers and all. Cash from financial activity, this shows that from where the company is getting the money, like proceed from the shares, or we can say borrowing, long term borrowing, short term borrowing. And it also shows that the buybacks and all, and dividend paid also. It shows as we can see, they are continuously paying dividends. They proceed from shares, as we can say, they diluted some of their share, I think. So ratios, now the final part is ratios, not the final part. Ratios, as we can see, the debtor days have been increasing over the years because as we already saw that they are not efficiently able to collect the cash here. Hardly 40% of the revenue they are able to collect. That's a very bad sign for the company, right? Now let's analyze the shareholding pattern. Promoters remains same because they have a strong confidence towards the company. Maybe FIIs are increasing their stake in the company from 8% to 12%. DIIs reducing their stake in the company. That's the bad sign for the company. Okay, so let's see if there are any recent developments in the company. So there is no recent development in the company. Let's quickly see the rating. Still given a AAA. Looks like the company is having a quite good financial condition to pay. It is obligations to its creditors, and it is creditors, and because they are having a low debt equity ratio, that's why. So overall the company is not doing well because they are look like it is not a stable business. They are not efficiently able to manage their operating profit margin. They are not efficiently able to manage their costs. They are not efficiently able to generate revenue. The revenue is quite too much fluctuating, so and also the as per the P and APS trend, it is quite overvalued now, and also the PAC ratio is in minus. They are not efficiently able to generate profit. So overall, my suggestion will be to avoid this stock for now. So thanks for watching. Have a